Tired of being in the dark about your investment? How does your portfolio's performance really measure up? Is your investment plan on or off track? Get the answer at PortfolioReportCard.com. Ron DeLegge's grading system of A, B, C, D, or F will tell you if your 401k plan, IRA, or other investment account passes or fails. But that's not all. If your portfolio gets an A, Ron will pay you $100. Go to PortfolioReportCard.com and find out if you pass or fail.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Gold prices crumbling, pushing to 4-year lows, and the worst may not yet be over. Stay tuned for that. We'll talk about the precious metals market crumbling. Also coming up, I'll be doing a portfolio report card for DC in Florida. He's 72 years old. He's retired. He's married. He sent me his $2.1 million portfolio. Holy schmoly, that's a lot of money. $2.1 million portfolio. We'll be doing a report card on today's show. I'll be breaking down some of DC's holdings. We'll look at the cost of the portfolio, his diversification, his risk, his tax efficiency, his performance. And then, after we've evaluated each of those crucial areas together, I will be giving his portfolio a final report card of A, B, C, D, or F. Will he pass or will he fail? Stay tuned for that. Also, we will get into some of your phone calls, your emails, your tweets. This is a live program. If you want to join us to talk about anything on your mind, financial, 877-711-5611. That's the number. Be sure to give us your first name along with your city, and I will get to you. If you want to talk about a particular ticker symbol, whether that's a stock, a mutual fund, or an ETF, just give me the ticker symbol when you call, and I will break them down for you and tell you what's going on. Now, if you want to get a portfolio report card where I analyze and grade your portfolio and tell you how you're really doing, you can get in touch with me. Go to PortfolioReportCard.com. If you get an A, you know what happens? I pay you $100. Now, we haven't had too many A's. We've had a few. But if DC's portfolio on today's program gets an A, I add to the kitty his $2.1 million portfolio. He can put inside it. That's only if he gets an A. So we've got a lot to get into on today's show. And again, if you want to join us, 877-711-5611 is the number. Let's begin with the crumbling gold market. My goodness, we saw gold pushing to 4-year lows. The price of gold really taking it on the chin. We even performing even worse has been the gold mining sector. And some of those inverse or short performing gold miner ETFs just soaring. And this is something that actually I want to tackle from an investment angle and from a trading angle. Number one, let's tackle it from the investment angle. Gold, as most of our listeners know, is a commodity, and commodities are one of the 5 major asset classes. And that all well-diversified portfolios should have at least some exposure to. So from an investment perspective, commodities, regardless of how horrifically they are performing, are still a major asset class and deserve to have at least some portion of exposure inside a well-balanced, well-diversified portfolio. Now, of course, you can determine personally how much that exposure should be. That's what you should be doing, each of us. But the point here is that I want to analyze and grade any investment portfolios that have, let's say, exposure of 20% or more exposure to precious metals. If your portfolio has 20% or more exposure to precious metals, whether that's gold, gold mining stocks, silver, I don't care if it's ETFs or if it's physical bullion, and you're above age 55, I need to talk to you. We need to have a fireside chat, and I want to begin that discussion by doing a portfolio report card for you. If you have an investment portfolio and you're 55 years old or older, With more than 20% of your portfolio committed to precious metals, you got to take Ron DeLegge's portfolio report card. I want to analyze and grade your portfolio. And then after I've done that, then we can have the fireside chat. But all silver and gold portfolios, I'll be happy to grade them and analyze them, especially the ones built by Peter Schiff. I really want to analyze and grade those because I will tell you what's really going on with your portfolio, not just its performance, but its cost and then the tax efficiency. Now, from a trading perspective or trading angle, because we've already addressed the investment angle, we know that commodities are a major asset class. Many people have overdone it, though. They've got, excessive exposure to this asset class that generates no earnings, no dividends, and it's becoming a big problem, especially for people that are reaching their retirement years, and they're over-leveraged, overexposed to an asset class with no income. It makes absolutely no sense. Now, from a trading perspective, and this is a completely different angle than the investment perspective, this has been a great, great trade. Now, if you don't subscribe to my monthly ETF Profit Strategy newsletter, I want to share with you what you've been missing. Because in the November issue, which was published last Friday, that was October 24th. Actually, that was 2 Fridays ago. October 24th, this is exactly what we said on page 4 of our newsletter under the subheading Deflation with a capital D. Quote, the big move down in crude oil prices is textbook deflation. It's also the current technical price trend, not just for the energy market, but the entire commodities group. And then we have a chart there that plots ticker symbol GCC, which is the broader commodity ETF, tracks a basket of 18 different commodities, versus GLD, which is just for gold. And we pointed out, and we show a chart of GLD versus GCC. GLD has held up better versus GCC, and therein lies the opportunity. In this case, we'd rather trade bearishly, and the quote continues, and in harmony with the longer-term downtrend for lower gold prices. And then we list some of the ETFs that we bought in preparation ahead, not after that fall. And man, I'm telling you, we nailed it. And sometimes we get home runs. We don't really swing for home runs. We kind of like the Moneyball approach, walks and singles. But man, when we get a triple or a home run, we'll take it. We'll take it because sometimes you get that kind of pitch where it's just such a fat pitch that you just have to swing for the fences. And that's exactly what happened in our November just issued newsletter. Page 4, that's time-stamped. It's not back-tested. And if you're not a subscriber, man, you've been missing out on this. I'm going to give you an update, though, on the price performance of a couple of the tickers that we mentioned on page 4 that just exploded in value this past week. DUST being one of them. That's the Direction Daily Gold Miners Bear 3X shares. Aims for triple daily opposite performance to gold mining stocks, and also JDST, which does the same thing, but for small cap mining stocks. So I'll get you caught up on what's going on with the gold market from a trading perspective. If you'd like, 877-711-5611 is the number. Give us your first name along with your city. If you own gold or silver or gold mining stocks and you're long, give the show a call. I'd like to talk with you. I'd want to see how much of your portfolio has exposure to this particular asset class, and whether you're ready for lower prices. Because quite frankly, if you think things are bad right now in the gold market, just wait. Just wait until year-end tax loss selling kicks in. We could easily see gold and silver prices drop another 10 to 20% by year-end. And so, follow the market. Look at what the trends are doing. Set your emotions aside. I know many people who have been peddling gold bullion to the public have been selling fear. They're fear-mongering types of people, and they're the ones that have been profiting from this fear by taking a commission on all this bullion and precious metals that they've been selling to the public. And meanwhile, it's the public that's been getting hurt from this horrible advice. If you're just joining us, you're listening to the Index Investing Show, 877-711-5611. Join the conversation. If you want, you can also tweet the program live at Index Show. My name is Ron DeLegge, and I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, I got a tweet from Tomac. What do you think about UDOW? That's ticker symbol UDOW. This particular ETF aims for triple daily performance to the Dow Jones Industrial Average. So, for example, if the Dow's up 1% on any given day, UDOW, that's a ticker symbol, will aim to be up, or should be up 3%. That's its daily goal. In November and December, stocks have historically gained around 1.5% since 1950. Another repeat would probably bode well for UDOW and others like it. By the way, UDOW is a short-term vehicle with 1 day up to a few weeks as the target holding period. So it's not a buy and hold long-term type of investment. It's a trade. And also, it's a non-core ETF or non-core portion of your portfolio. That's where it would go. Before you add it to your portfolio, make sure you've built the core, the foundation of your portfolio before venturing into something like UDOW. Thanks for that tweet. That's from Tomac. If you want to send me a tweet, a question, a comment, send it to @IndexShow. That's my Twitter handle. And if you're just joining us, you're listening to the Index Investing Show. We're going to be doing a portfolio report card for DC in Florida. He's got a $2.1 million portfolio. It's divided among an IRA and a brokerage account. So before we get into that, though, I want to just give you a quick recap on the crumbling gold market. As I explained to you in the first segment, gold this past week just getting clobbered, falling almost 5% in value. Ticker symbol GLD, that's the Spider Gold Trust, which tracks the price of gold bullion. Gold now at 4-year lows. And if I've all my inadequacies, if I've been unable to explain to you the chaos in the gold market, maybe this music will help you to understand the chaos right now. Yes, that's the chaos right now happening in the gold market. And hopefully you're not on the receiving end of a TKO, because the worst may yet be ahead. As I said to you, listen, it's just beginning November, and we haven't even seen year-end tax loss selling kick in on precious metals. And that's why very, very strong possibility that lower prices are yet ahead. I mean, we saw this in 2013. Just as all the gold experts were proclaiming that the worst was over in October of 2013, they forgot about year-end tax loss selling. And, of course, it peaked really in late December. That's when the selling kicked in. And so I think we could very well have a repeat of that. But more importantly, from a trading angle, this has been an absolute home run, a triple. I talked about this in my ETF Profit Strategy newsletter, which is published every single month at etfguide.com. On page 4, before this even happened, we were setting up subscribers with the exact right way to play this particular theme of falling or lower gold prices. Take a look at the ticker symbols that we recommended just ahead of this latest collapse in gold. Ticker symbol DUST. This was a trade that we entered into on Monday. On Monday, October was it 27th? I think that was just a couple days after the newsletter was issued on the 24th. That should have been, that's the 27th. So GLD, which tracks the price of gold bullion, that was the one that got knocked out this past week. But the ones that we had recommended jumping into, DUST and JDST, just over the past 5 days alone, DUST up 61%, JDGST up 76%, and we've already exited those positions. I mean, these again are short-term vehicles, not the type of buy and hold investments. But again, what I'm trying to explain to you is that there are opportunities for those of you that carve out the portion of your portfolio designated as trading money. That lies therein lies the opportunity to complement your core portfolio. So these are some things that I just want to highlight for you. And do not listen to the gold experts that keep telling you, as they have been since 2011, that the worst is over, or that this is the bottom, because it's not. In fact, we could see the bloodbath in precious metals really kick in, I think, over the next month or two. I think especially with year-end tax loss selling, and we follow the technical patterns and the charts, which all indicate even lower prices ahead. And all I can say is hashtag be ready. Hashtag be ready. You're listening to the Index Investing Show. 877-711-5611 is the number. If you've got a gold or silver portfolio, let me analyze it. Let me grade it. Go to portfolioreportcard.com. I especially want to analyze and grade the investment portfolios with people who are above age 55 that have 20% or more of their assets committed to commodities or to precious metals. I really, really want to analyze and grade your portfolio. And let me do that. PortfolioReportCard.com. If you get an A, I will pay you $100. Now, speaking of Portfolio Report Card, let's take a look at DC's portfolio. He's got a $2.1 million investment mix. It's divided among an IRA and a taxable brokerage account. He's 72 years old. He's retired. He's married. He contacted me. He's actually a subscriber of my ETF Profit Strategy newsletter, but he manages his money on his own. He's not really a trader type, but he told me some interesting things about his portfolio, and I want to mention this before we get into the details of what his holdings are. He told me that he manages his portfolio for growth, but he also wants to protect it on the downside. So he's worried about another 2008. That was something he specifically told me, and I think that's something I worry about too. I think it's natural that we all have that in the back of our mind. I mean, could this, what happened in 2008 or 9, happen all over again? So that's on his mind. He has 18 mutual funds, 10 individual stocks, 9 ETFs, and then 2 closed-end funds. And we'll get into some of what his holdings are, his largest holdings, etc. So what I'm going to do is analyze and grade his portfolio in 5 key areas, and then I will assign him a final grade of A, B, C, D, or F. So let's begin with the first area, which is cost. The first thing here that we all need to remember is that minimizing your investment cost to an absolute minimum is every investor's job. That means deliberately reducing trading commissions, fund fees, and other hidden costs that scrape you. Now, the weaknesses in controlling investment cost inside DC's portfolio are immediately apparent with his bond holdings. For example, one of his biggest holdings is the Fidelity Floating Rate Bond Fund, ticker symbol FFRHX, has an expense ratio of 0.70%. It consumes almost 20%, that expense ratio, of his fund's current yield. Imagine giving away 20% of your income to a mutual fund company. Well, that's what he's doing by holding FFRHX. It's way, way too much. Another large holding is the Pimco Total Return Fund, ticker symbol PTTDX. In this fund, 56% of the Pimco Total Return Fund is being eaten away. It's being vaporized by fund expenses, the yield, the annual yield. So that's unacceptable, and this is a continuing or a repeating theme within DC's portfolio, and I think it's a problem. And that's just one example. I mean, he owns other funds in other categories, like in an international space. He owns a whole bunch of Matthew Asian focused funds, and there too, expense ratios are elevated, and I don't really see him deliberately going about his portfolio construction in such a way that really minimizes cost. So I think he needs to be doing a better job when it comes to cost. We'll look at some of the other areas of DC's $2.1 million portfolio when I return. Go nowhere!
The Index Investing Show with Ron DeLegge.
Are you frustrated with how your investments never seem to grow? Do you feel like your investment plan might be off track? Are you concerned about your portfolio's fees, taxes, and risk? If you answered yes to any of these questions, you're not alone. Get the help you need with Ron DeLegge's free portfolio report card. Get a snapshot of your current investments and find out if your financial plan is really on track. Go to etfguide.com and click on Ron's portfolio report card. Millions of people are investing blindly in the stock market. Don't be one of them. Ron DeLegge's free portfolio report card tells you everything you need to know about your portfolio's fees, taxes, and risk. Go to etfguide.com and click on Ron's portfolio report card. Traditional IRA, Roth IRA, 401k plan, or brokerage account. It doesn't matter what you have. Ron's free portfolio report card will tell you everything you need to know. Go to etfguide.com and click on Ron's portfolio report card. Don't invest without it.
All right, welcome back from the break. At Index Show is my Twitter handle. You can email the show also with any questions, comments, concerns, complaints. Ron at indexshow.com. My name is Ron DeLegge. I'm the host and producer of this weekly broadcast. I also publish the ETF Profit Strategy newsletter at etfguide.com. You can check that out. I encourage you to become a subscriber. You can also check out some of the latest articles that I've written, including my most popular one from this past week is Gold's Knockout Punch Coming. You got to read that one. I've been tweeting that one out. It's also on our Facebook page. If you'd like to get a free portfolio report card where I analyze and grade your portfolio and tell you how you're doing in 5 key areas: cost, diversification, risk, tax efficiency, performance, and then I'll give you a final grade of A, B, C, D, or F. Get in touch with me. Go to portfolioreportcard.com and get started. If you get an A, I pay you $100. We're looking at DC's portfolio. He's 72 years old. He's retired. He's married. And he's got a pretty good sized portfolio, $2.1 million investment mix divided among a traditional IRA and a taxable brokerage account. He owns 18 mutual funds, 10 individual stocks, 9 ETFs, and 2 closed-end funds. Those 2 closed-end funds, by the way, ticker symbol PTY and EXG. We already looked at the cost of his portfolio, and we found that he wasn't doing very good or isn't doing very good at minimizing his annual fund expenses. And so he's got to do some improvements there. Next up, let's look at diversification. By definition, investment portfolios without market exposure to the 5 major asset classes, stocks, bonds, commodities, real estate, and cash, are not fully diversified. Now, I see that DC's made an effort to have a little bit of diversification in his portfolio. I see this with his equity or stock exposure. He owns international stocks with mutual funds like the Harbor International Fund, ticker symbol HAINX. He also owns a Tweedy Brown Global Value Fund, TBGVX. That's on the international equity side. For domestic stocks, his largest holdings are the S&P 500 Equal Weight ETF, ticker symbol RSP. He also owns the Vanguard Dividend Appreciation ETF, ticker symbol VIG, along with a few small cap stocks. Now, the problem with DC's diversification is that most of the funds that he is holding are not diversified core holding proxies for the asset classes they're tracking. So that's what I want to see in a core holding or major holding inside your portfolio. I want to see a good proxy for that particular asset class. So, for example, commodities. Well, if you bring me one commodity ETF focused on a single area of the commodity universe, like ticker symbol OIL, which tracks oil, well, that's not really a good proxy for the entire commodities group. Something like ticker symbol GCC would be a better proxy and a core holding because it aims to track the broad or entire universe of commodities. So this is the problem with DC's portfolio. The bulk of his international equity exposure, along with stock exposure, is in active funds that may hold cash, possibly even deviate from their underlying investment goal. That's called style drift. Some of these international funds may even hold domestic stocks because they're allowed to. So this is a problem. And again, it's repeated with his bond fund holdings. I mean, all of them are active funds. You know, he owns the Pimco Total Return Fund. Loomis Sales is another one. LSBRX, got that one in the IRA. Fidelity Floating Rate Bond Funds. That was something else, too, that I noticed. He's got unnecessary duplication. Certain funds that own the same asset class or same thing. I mean, that doesn't make any sense at all. He owns 3 different floating rate bond funds, EAFAX, FFRHX, and SAMBX in the same accounts. And that, by the way, accounts for those floating rate bond funds just over $400,000 of his portfolio. And that's completely unnecessary duplication, and it gives really totally unnecessary overexposure to the same thing. So what I see overall in terms of diversification on DC's portfolio, he's got an uneven balance. Some parts of his portfolio are over-diversified, like with the bonds, and then at the opposite extreme is under-diversification in other parts. He also has no exposure to commodities and real estate, 2 major asset classes he misses, so he's got to improve on diversification. If you're just joining us, you're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're doing a portfolio report card today for D.C. in Florida. He's 72 years old. He's retired. He's married. He's in good health. I'm analyzing his IRA and his brokerage account, and he's given me all the holdings. He shared with me his account statement from last year and from this year so that I could look at what he holds and the performance, calculate that. And so this is what he's doing. He self-manages this money, by the way, without the help of an advisor. So he is on his own. Now let's take a look at the next category because we already looked at cost and diversification. Let's look at the risk of his portfolio. This applies to all of us. A portfolio with the correct level of risk always matches the risk limitations and character of the investor. That's an eternal truth. And it doesn't matter what year it is or what month it is, that will always apply. Now, the question is DC's portfolio compatible with his age, his temperament, his life circumstances, his goals, and his liquidity needs? That's the question. Well, DC's overall asset mix in this $2.1 million portfolio, he's got 49% exposure to stocks, almost 32% exposure to bonds, and then just over 18% exposure to cash. So that's his overall asset mix. He told me that growth with downside protection is his goal, but both strategies are the exact opposite. That's because growth implies risk-taking, whereas downside protection implies capital preservation. So the question is, which of these completely opposite investing strategies best represents the real DC? Which is it? Is it growth or is it capital preservation? Because a stock market decline between 20 to 40% exposes a DC's portfolio to potential losses between $200,000 to $400,000. Can he handle that kind of heat? I don't know. So if protecting his capital is his true goal, I would say having almost 50% of his portfolio committed to stocks is probably too high for a 72-year-old conservative investor. So he needs to do some work when it comes to risk. We'll take a look at the final 2 categories of DC's portfolio, and then I'll give him a final grade in the next segment. We'll take a look at his tax efficiency and his performance Again, if you're just joining us, you're listening to the Index Investing Show. I'm your host, Ron DeLegge, and if you'd like to get a portfolio report card, you want to see how your investments are really doing, you want to uncover some of those hidden fees, you're suspicious that your advisor, if you have one, isn't executing. Well, let me tell you if he is or if he isn't. Go to portfolioreportcard.com and I'll tell you how your portfolio does, not just on performance. That's, of course, the most important one. That's really the bottom line, but it's not the only thing. You've got cost of your portfolio's risk, your diversification, and your taxes. All of that impacts what your final performance is. So don't just tell me that performance is the only thing I want to look at because, well, you got to look at the complete picture. 360-degree unobstructed view of what's really going on with your portfolio. That's what this is, a full body exam for your investment portfolio. Go to portfolioreportcard.com. If you'd like to join me and talk about anything else on your mind, a particular stock, mutual fund, you want to talk about the crumbling gold market, let's do that. 877-711-5611. I'll be right back.
Investing Show with Ron DeLegge.
Scrambled eggs. Scrambled eggs. That should have been a title for one of the Dr. Seuss books because that well describes diversification of so many investment portfolios. Scrambled eggs, all over the place, indiscriminately in places that you're not even aware of. And this is a problem. It's one of the things that we just identified in DC's portfolio. I'm Ron DeLegge. You're listening to the Index Investing Show. We are doing a portfolio report card for DC in Florida. He's 72 years old. He's retired. He's married. And his diversification plan, I would say, very much represents what I would call scrambled eggs. It's just all over the place. He's got unnecessarily duplication of certain areas, like 3 different floating rate bond funds. Again, diversification is not about how many holdings that you have inside the portfolio, but how well or how evenly distributed across multiple different asset classes that those funds have. So theoretically, and actually in real life, you can get diversification by holding just a few different funds that broadly represent various different asset classes. So you don't need to have a lot of holdings to achieve authentic diversification. So we looked at the cost of his portfolio. He didn't do very good there. Diversification, we've already beaten that dead horse. Risk, he I think needs to improve here. What worries me most about DC with regard to his $2.1 million portfolio and the risk of it is what he says to me. He says he wants growth, but then he wants also downside protection. He doesn't want to have a repeat of 2008 because he got really hit that year like a lot of people did. He doesn't want to see that happen because, well, he's older and he doesn't have a lot of time to recover if that happens again. So I just don't think that having 49% of his exposure to stocks really accurately reflects his true risk character, especially since I feel that queasiness in his stomach when he mentions the year 2008. So I think he's got to just shore up his portfolio in terms of risk. I'm not saying to sell completely all of his stocks, but I am saying that he probably has to dial it down a little bit. So let's look at tax efficiency, and I was glad to find that DC, overall I think he does okay on taxes. He's got a few of his bond funds correctly allocated in his IRA. And of course, bonds, when we start talking tax efficiency, bonds are not a very tax efficient asset class just because the majority of returns from bonds comes in the form of income, which is taxed at a higher rate, which makes them best suited for your tax-deferred retirement accounts. Whereas with stocks, the vast majority of gains from them comes not from income or dividends, but rather from capital appreciation. So that's why your equity funds are best positioned in your taxable accounts. And, this is called, by the way, this very simple strategy, it's something called tax asset location. Asset location, and we want to have smart asset location. And when we put smart asset location along with smart asset allocation, then we've got a winning formula. So I think he does okay in terms of tax efficiency. No real warning signs or big problems in that area. In terms of performance, what is the right performance standard for judging an investment portfolio? Can anybody answer that question to me? Is it how we feel? Is it what we think? Is it what our financial advisor tells us our performance is? Is it what the S&P 500 is doing versus what our portfolio is doing? What is the right standard of investment performance when it comes to looking at our own portfolios? Does anybody know the answer to that question? I do. It's most certainly not distorted peer group comparisons that the mutual fund industry uses. These are very common. And it's really the right answer, the right performance standard is how a person's portfolio performs relative to a blended mix of passive index ETFs that correspond to a person's asset allocation. That's the correct standard. And anybody that disputes that, well, they just don't want to keep track. They don't want transparency is what they don't want. They don't want accountability. Anybody that disputes that very high and robust standard. So that's the standard that I use on my report card, my portfolio report card, in evaluating all the portfolios that come through. And that's the same standard that I use for DC's portfolio, this $2.1 million portfolio, which at the end of October 2013 had a value of 2.100. Well, let me just read out the exact figure, okay? $2,101,978. That's what he had in October of 2013. Fast forward to 1 year later, his balance increased to $2,175,000. So if we calculate that gain of $73,000, he actually increased his portfolio by 3.5%. So our benchmark of ETFs that match his asset mix gained just over 6%. And his final performance is not good. His final performance, his underperformance, really says it all. He underperformed the benchmark by a substantial mark. So the final report card for DC is a D. This is not a good score. It means that his portfolio is unsatisfactory in most of the areas. You could really see his problem areas are diversification, cost. Of course, the good thing here is we've had a favorable market climate over the past couple of years since 2008. So, DC's got that going for him. And I would say, that's the time to fix the portfolio is when the market climate is favorable versus when it's unfavorable and you're scrambling like everyone else to fix what's wrong with your boat. And the boat is in the middle of the ocean and you're sinking. So that's the good news. DC has time to look at this, meditate on it and see what he's doing right, see what he's doing wrong. I mean, that's the whole point of the portfolio report card. It's not to embarrass you. It's not to make you feel dumb. It's really to help you identify the strengths and the weaknesses of your portfolio and to shore up what you're doing so that you can put your money on track and stay there. So, DC, keep in touch. Let me know how you're coming along. Not a good report card, but here too, you've got some things that you can work on and make some improvements. If you're just joining us, you're listening to the Index Investing Show. I'm your host, Ron DeLegge. And, few reasons, those of you that have not taken my portfolio report card challenge, a couple of reasons to think about doing this. Number one, you want to eliminate the unnecessary financial chaos, clutter, and chatter from your life. Great reason to take my portfolio report card. Or you want to 100% confidence knowing that all the holdings within your investment portfolio or retirement savings account aren't there by accident. That's another great reason for getting a portfolio report card. How about you want to identify and eliminate hidden risks that may pose a threat to your financial stability? How about you want a comprehensive explanation of your investment portfolio in jargon-free language that you can understand? That's a great reason to take a portfolio report card. How about you want to completely extinguish all doubts about your investment plan? How about you don't have the time, the energy, the desire, or acumen to learn 1,000 different ways to invest your money? Another great reason to take the portfolio report card. You want to spend less time worrying about your investments, more time with your family and other pursuits. Another fantastic reason to take the portfolio report card challenge. Go to portfolioreportcard.com and get in touch with me. Now, taking a look at what key market indexes are doing so far in 2014, stocks continue to rally. Ticker symbol VTI tracks the total U.S. stock market ahead by a balmy 8.4%. And those are the facts. Agree with them or disagree with them. Market prices are the boss. Stocks continue to move higher. And we've just entered a favorable seasonal period for stocks historically. So November, December, January have been good. And if that historical pattern repeats, stocks will only add to their gains. Some of the other areas that have been doing good, REITs, ticker symbol VNQ, up 22%. Utilities, another great performing industry sector, XLU ahead by 20%. And even better, healthcare stocks, XLV up 21%. Well, that does it for another episode of the Index Investing Show. Join us again next week. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.